kick off. So it's really nice for you to join today. As we all know, we're all set up businesses with the odd exception, with the firm intention of selling them to make a capital gain. And this will be a session for the next 90 minutes talking about those issues. A very warm welcome to Natalina, who is a specialist corporate financier, actually in the publishing industry, but has for years and years and years worked on both buy and sell side around selling smaller companies. And I thought her particular experience would be very useful. So she and I are going to kick off this session and chat for 20 minutes or so. And I'm going to try and extract some useful insights from her to help you all understand this whole topic. And then Helen, I think some of you will have met before. Lovely to see you again, Helen. She's going to give us the legal perspective and give us all the answers that we could possibly need to know. So in a trade sale in particular, these two ladies are representative of the two people you would spend most of your time liaising with typically. So we have got the dream team here, particularly if you're, I suspect, in the publishing industry. So we will just sort of kick off, if I may. So Natalina, how many businesses have you bought and sold?
Got to unmute myself. Hello. Hello. Lovely to be here, and lovely to meet everyone virtually. How many businesses have I bought and sold? Over 120. I think it's 140 now. Yeah.
only a small number then. And over roughly what period? You've been doing this a while, haven't you?
Yes. So 2 long decades.
Okay. Gosh. So you've got sort of. Does that make what 5, 6 a year? So you're doing one every 2 months?
That's about the run rate. Exactly right.
Okay. So does that mean it only takes 2 months to sell a company or buy a company? She says, knowing what the answer is.
Yeah, the average time period is 6 to 8 months. If a transaction is arranged by Bertoli Mitchell, and that's our typical process. Occasionally it can take longer. It can take up to 12 months and sometimes even longer than that if there are special circumstances, if the CMA, for example, is involved. We did have that arise once, and that meant that our transaction was subject to CMA approval and took about 16 months on that occasion. But yeah, so 6 to 8 months is normal. Now, we don't just start sort of with completely dry pad, if you like. It is quite often the case that we're in discussion with potential vendors in the 2 to 3 years that lead up to then launching the process.
Okay, so you're saying it's basically probably 3 years from the day you decide you want to sell to the actual sale completing and it being done, of which 2 years plus is sort of prep, and 8 months, say, is to actually go through the sales process.
It might be up to 2 years of prep. Exactly right, Modena. And that obviously depends from situation to situation.
Thank you. With when sort of entrepreneurs in particular come to you saying they want to sell their business, because I think most of this audience are sellers rather than buyers. I know you operate for large publishing houses as well as small companies. What place do they need to be in at that sort of 8 month period to actually start the sale process? So I know you've kindly helped me sell our family business a few years ago. Very successful it was too. Thank you. What sort of should people be doing to prepare, or maybe what do you find are the common problems when people approach you saying, "Oh, now I want to sell this business"? Is there a sort of quick list of things common problems you find which might delay them being able to sell, or anything else?
Yes, I think the most common problem that we encounter, and this may be slightly publishing specific, although it's a generic point, is perhaps not watertight or wholly professional financial management. So we will often, in that 2-year period, be helping our clients to review their processes, professionalize their management accounts processes, maybe even reviewing their accounting policies, which can vary significantly from business to business, as we all know. Ensuring the most watertight approach, professional approach. I mean, I can talk perhaps to some of the common areas where we will gently guide our clients towards perhaps more prudent accounting policies, actually. So we will often take a close look at stock management and whether write-downs are required in respect of stock. We will often look at whether overheads are capitalized in any way, and if it's appropriate, we will probably adjust such a policy towards actually a writing down capitalized overheads. It's really around cost of sales, gross margins that we will tend to focus, and that's because this is a general point. This is not just publishing specific. Gross margin is a key metric for strategic trade purchases. They may be able to make a few percentage points difference in terms of gross margin performance in a business under their aegis, under their ownership, but where they may, but that's not a significant adjustment, if you like. Where they may expect to make very big adjustments are actually in the indirect cost lines.
Okay, so basically there's a lot of, usually, isn't there, the reduction in employees and stuff like that when they consolidate. So putting it tactfully, I suppose. And so gross margin, everything. I know that's something often, I hear people talk about, wow, that was an amazing sale for, gazillions of quid, and it was 25 times the revenue or whatever crazy tech company is getting, which is fantastic. But I think you'd probably agree with me, Natalina, that at the end of the day, buyers buy on when they think they can get payback, don't they? As well as they don't just buy it for the, to pay you a lot of money. They buy it because they think they're going to enhance earnings from doing the transaction.
Absolutely right. And I mean, I think that obviously the objective is to drive as high a price as possible in the circumstances, but it is actually, for more traditional businesses, quite difficult to get buyers to price in the upside from future developments that will be wholly financed by the buyer. That is quite tricky in traditional businesses, and so it's worth sort of being clear-sighted about that before deciding to sell. Unless, I mean, one way of bridging, if you like, the potential valuation gap is in the way you structure the payment of the consideration. So, if you really do want to share in the upside that's created by the purchaser, you might be willing to go into some sort of earn-out arrangement and take quite a lot of the purchase price by way of performance-based deferred consideration. I have to say that most of our clients don't do that. So our experience is that for the most part, entrepreneurs like to receive all the cash up front with no contingency at all. And I'd say 9 times out of 10, that's the type of deal that we deliver in the end. But there are special situations where it does make sense to have that burnout. However, one does have to be really careful, and perhaps you might talk about that with Helen later on, really careful about getting what are called vendor protections, so that the results in the period following completion of the transaction in new ownership aren't actually manipulated by the buyer to the detriment of your earn-out.
Oh, very interesting. So what are the 3 big things that buyers use to chip the price at the last minute?
At the last minute? Never when Bertoni Michelin's involved. Surprises. Buyers don't like surprises. So part of what a really good advisor will be doing is undertaking either a formal or informal due diligence review before you even go to market, so that you then build a process which is prepared for some of the weaknesses in the business, because every business has the odd hole or two, the odd weakness or two. So the key thing is actually to let buyers know of those items at the right time and not too late. If buyers find out about things too late, you're giving them an obvious lever to price to. What else? Trading, current trading. If projections are for X result and actually it's Y result that's apparently being delivered, that's a major reason for potentially price chipping. And completion accounts, I would say, would be the third thing that I would select. So in share deals, a part of the price will hinge on the balance sheet at closing in some way, shape or form. That's effectively to protect the buyer from the vendors walking off with some of the assets pre-completion, taking some excess cash out of the business, or selling down stock, or exceptional dividends, that kind of thing. And that's fair enough. That the review of the balance sheet normally takes place in what's called a completion accounts true-up in the months following completion. About month 3, month 4 is when that process takes place. Agreeing what the balance sheet should look like, the net asset value that one's targeting at closing, is something that can be deferred until typically the last 2 or 3 weeks in the lead up to completion. It's obviously a key number. So, it might be appropriate to target $1 million of working capital in the balance sheet at closing, or 2 million, or $500,000, but these are big numbers and they can jump around a lot. So having an advisor or a group of advisors who can help you to get the right target agreed with the buyer is critical.
Thank you. EMI schemes are notorious, aren't they? Why are they notorious?
That's another one. Yeah, that's true. They often fail. It's really important if you are putting an EMI scheme to get professional advice, and to make sure that to be assured that your advisor or you or your team has got HMRC's approval all the way along. And that is because in our experience, HMRC hasn't necessarily always approved along the way. So when it comes to a transaction, the scheme is deemed to fail, and suddenly those employees who thought that they were going to get a very tax favorable pot of money are exposed to paying income tax on that pot of money. And then there can be quite a heated negotiation between employees and vendors, the majority shareholders, as to who picks up the shortfall, the tax shortfall that the employees have suffered. So you're quite right. That's a biggie too. Yeah.
Good. Yes, I know that we've had that, and another friend of mine I was talking to recently, she had a terrible time with the EMI scheme at the very last minute, just as things were about to be signed, and it threatened to derail the whole transaction, even though everything else was all good. So I do think something, and we have done, I think, a seminar on EMI schemes, haven't we, Helen, earlier in the year? So there is a recording available to learn more about those. But I think it's something that people often think it's only a one-way ticket, and keeping the really good paperwork for the EMI scheme and valuations for EMI schemes, it's a big issue, and will become more so because HMRC has a data lake behind behind the applications you put in. So their ability to challenge valuations is going to significantly increase. It's that they haven't got any resources right now, I hear, so they can't. Right, but it may change. Could you give us? We've only got a few more minutes. Amazing how time goes, but could you give us any sort of quick tips on things like warranties and indemnities? Are there any sort of big highlight things that people should think about?
Yeah, I mean, I think, and Helen, you and Helen will talk about this more, I'm sure. But I mean, it is really important to get the best possible lawyers you can, who do understand your industry and really understand your business. So preferably have long prior experience of deals very similar to yours, therefore help you to get warranties and indemnities that are actually bespoke as possible to your particular business, rather than very generic, which is, unfortunately, the latter is quite common, unfortunately, when businesses are poorly advised. So I am on the side of actually paying properly for lawyers. Even though they are very expensive.
This is unprompted, by the way.
This is unprompted. I'm definitely in favour of that. I mean, in warranties and indemnities, typically under English law and under typical M&A transactions, are a sort of, well, they're a means of actually getting some money back on the price you pay. Obviously, nobody wants to give back some of the consideration that they've received. So you want to be able to get to agree to warranties and indemnities that are agreeable, therefore true, so that purchaser doesn't actually have a means to come back and get some money from you. You need to insist that your lawyers take you through each and every warranty and indemnity that you are agreeing to, and that you genuinely understand it. Buyers and sellers can get quite tired at the end of a long selling process. But agreeing the warranties and indemnities usually occurs in the last 3-4 weeks of the process, and you need to keep your energy up and wits about you to ensure that they really are, not full of holes, and therefore not potentially giving your purchaser a chance to chip away after the deal is done.
Thank you. We're seeing often a lot of private equity and venture capital, I think, will increasingly become an option rather than a trade buyer. Is there any particular, this is my last question, by the way, is there any particular difference are you seeing that in the publishing world? Or is there any advice whether it's effectively a financial structuring or financial engineering organisation buying the business rather than a strategic trade acquisition? Are you seeing anything there which is pertinent that's worth commenting on?
We're not yet seeing a great deal of it, although we're expecting to see more of it, to be honest, Modwena. But I think the key thing I'd highlight for today's discussion is just assuring yourself as to who their advisors are and how many advisors, because due diligence can be laborious, and it will be even more laborious if you get advisors coming in one after the other. Ideally, you'd want to have all advisors conducting their due diligence on your business at the same time, rather than piecemeal.
Yeah.
Because when it is piecemeal, the risk is that advisors are significantly duplicating. So you end up dealing with, the same questions 4 times, which is expensive and wearing and can put at risk the transaction, because one of the key things in any transaction is momentum, actually, just really trying to get to the end point as quickly as possible, safely, so not too fast probably, but still as quickly as possible.
Thank you. Well, we sort of used up just a bit over our 20 minutes. Would you believe it? It's disappeared already. So just to give us a bit of enthusiasm, as you say, 6 to 8 months, what's the quickest you've ever sold a company?
A company rather than in a sort of assets transaction, they're faster, but a company, a share deal, 5 months, 4.5 months.
4.5 months. So it is possible. And, and an asset sale? How quickly can those happen?
Quickest that we've ever done, 3 weeks.
3 weeks. There we go, guys. All right. So that's clearly in publishing. Usually there are physical assets like books to sell, aren't there, and contracts. So, but Natalina, that was fantastic. Is there any, so we could take probably one, 2 questions if there's anything for Natalina, but I know sadly she's got to disappear. But if any of you are in the publishing industry and want to sell a business, or indeed buy one, Natalina's your lady. So just I'll if you have a question, could you put it into chat, please, or Q&A? Or have we just wowed them, Natalina? We've just given them all the answers they ever needed. So that's all right. Okay, so nothing's coming in and I'm very conscious of time. So Natalina, thank you so much for joining us. I'm not sure if you're going to stay or whether you've got to disappear, but I think if you do just perhaps read out, you'll say your email address just in case anyone wants to have a chat to you. But you are a specialist in publishing, aren't you? So you don't just sell any old business. So yes, I think just a caveat slightly so you don't get inundated.
That's right. Thanks so much, Modwena. Yeah, publishing and information services. So actually, although it is a specialism, it's quite broadly defined. So would love to hear from anyone who has any questions, queries. Do get in contact with me, and my email address is nb, so my initials, at bertolimitchell.co.uk. And as I say, yeah, please get in touch. Would love to hear from you.
Thank you so much. Well, bless you. Really appreciate it. Have a lovely day yourself, and we'll catch up soon. I'm guessing you're leaving now, are you? Or are you going to stay around? Okay, all right. Okay. Well, thank you very much. Okay, brilliant. Bye-bye. And Helen, a warm welcome to you again.
Hello.
Lovely to see you. So yes, so you're now going to be the extremely well-paid but extremely high-quality lawyer who's going to solve all our legal problems, aren't you, in this topic? So I'm going to hand over to you, and I think you've got a presentation to share.
I have, but just to start by saying that I can actually top the 3 months with one transaction in 2014, which was completed in 2 weeks. It was incredibly intense. It was a very small business in the IT sector, and so there were sort of 4 people working in their garages who were selling their business, and the buyer wanted to buy the business in time for a trade show. So they said, right, it's 2 weeks or not at all. So they managed to go through the entire process. It was quite good in terms of our leverage as sellers. We got quite a nice outcome, but it proves it is possible, because basically from a buyer's point of view, there's nothing to stop a buyer just signing a stock transfer form and buying a business. So they could always just go ahead and complete without the kind of the months of due diligence, but that's very uncommon, I have to say.
Oh, fantastic. Well, 2 weeks, gosh. All right, we're on a countdown now. So Helen, yes. So Helen, your camera's gone off, but I think you're putting up your slides. Is that right?
Right, I will. If you can everyone see my slides? Can you still see me?
At the moment I can see, you're showing me. So you need to toggle on your computer, I think, across to your PowerPoint.
Yeah.
So if you now on your go, there you go, perfect. That looks fantastic.
Great. Well, thank you, everyone. I appreciate you joining this discussion around selling businesses. It's a key part of our work here at Gannons. We probably have about 12 transactions on the go at the moment, anywhere between signing heads of terms and completing. And so it's sort of seeing everyone through the process. My top tips are, from the point of view of buyers, don't take it personally. From the point of view of buyers, do understand that sellers take it personally, especially if they're the founders. They've set up the business, they've sort of put blood, sweat and tears into the business, and they will take your incessant questions personally. Conversely, my top tip to sellers is
Helen,
Yes.
sorry to stop. Could you come nearer to the mic, because it's quite hard to hear you?
Oh yes. Sorry, is that better?
That's better. Yeah. So you're going to have to stay quite actually talking at the mic, I think. I'm afraid. Sorry.
Okay. I will. Yes. All right. Do let me know again if you can't hear at any point. Yeah. So it's really just to say to buyers that they will never understand why sellers get so irate about the incessant questions, and to sellers, look, buyers are going through a process. They need to know everything about your business, and that's why you're going to get these questions. I think Natalina raised an interesting, a good point, which is that it's a sequence of questions and the repeated questions from different advisors that can be very wearing. But it's just sort of starting from an understanding that this will be a process. My usual rule of thumb is think about selling a house and times it by 10, and that's about where you'll be on selling a company. It is a process, and but you do get through it, and hopefully can sail off into the sunset at the end of it. So, adding my slides here. So the first things to think about are, before selling your business, it's worth taking a step back and thinking why you're actually wanting to sell, because that will help frame the whole process. If you're wanting to sell because you're actually a pure entrepreneur, you like starting new businesses rather than the day-to-day administration, then you may have a different approach to the sale than if you're somebody who's heading for retirement or wanting to leave for reasons of ill health. So it's really thinking first about what you want to achieve in your sale and sort of fitting everything around that. That also is part of what you want to sell. That most people were in our discussions, and Natalina was mainly talking about the share sale. That's more common, partly for tax reasons. It's usually more efficient for sellers to sell the shares than to sell individual assets, which then go into the company and need to sort of somehow get that money out of the company. But from a buyer's point of view, they might be looking at an asset sale because then they're cherry picking particular assets. So it's just to confirm that the difference in terms of a share sale versus asset sale is, if you're selling the shares, obviously the customers don't know any difference. The employees don't necessarily know any difference. On Monday, the seller owns the company. On Tuesday, the buyer owns the company, and nothing really moves. Whereas for an asset sale, the individual contracts all need to move from one company to another. So you're needing to approach all your counterparties to say, we're changing, there will be a different person who you're in discussions with, and a lot of customers and suppliers might use that as an opportunity to reopen the discussions, which is why, from a seller's point of view, it's not just the tax, it's also the process. They might find that a share sale is much more efficient from their point of view. The next point, how much do you want to sell it for? Well, obviously, as much as possible, but it's thinking through whether you'll trade off the upfront payment for an earnout for a higher price, looking at the different valuation methods. There's obviously very many, and it's again, looking back at the analogy of a house sale, if you can compare sales of similar businesses, that might give you a very good starting point, because then you can look at what you're likely to achieve. Ultimately, it's what somebody will pay for it. But if you've talked to a valuer and thought about the discounted cash flow method and the EBITDA method and multiple of profit and asset valuation, and look at all the different approaches, you might have a better idea before you start approaching sellers. So then they're preparing your business for sale. The first and most important is, I think, again, we touched on this previously, that the financial management and preparing up-to-date accounts. That will be the first thing that buyers will look at, is your accounts. And it will give them an idea as to how well managed the business has been. So it's really worth getting your accounts in ship shape and thinking through how those appear. There's obviously tidying up general matters that could cause issues. If there's disputes about invoices, or if there's a lease that's not continuing, if there are some employees that don't have full contracts, and particularly with early stage businesses, there could be an awful lot of handshake deals out there. So it's a case of putting contracts in place to reflect that. The next point about reducing dependence on the owners, and this is particularly with the kind of businesses we deal with, which are still founder run. There will be people who have all the knowledge inside their heads, and they need to somehow get that on paper into handbooks, share it with people who will remain in the business, so that when the buyer comes along, they can continue without necessarily keeping the owners involved, particularly if the owners don't want to be involved. Considering the deal and tax structure, this is where you look at your company books, look at the shareholding, particularly if you are looking to benefit from business asset disposal relief, BADR, what used to be entrepreneurs relief. So there it's vital that you've held 5% of the shares with full rights, that's voting, dividend and capital rights, for at least 2 years prior to the sale. So some people make horrendous mistakes by transferring some shares to a spouse, thinking that's going to be beneficial, but that spouse doesn't work in the business, so therefore wouldn't qualify for the tax relief. And otherwise, there may be some shares with people who are not looking to benefit on an exit or otherwise. So it's really take a look at your share structure and make sure that it's ready at least 2 years before the sale. The final point, engage professional advisors. Obviously, we would say that, but really whether you publicly engage professional advisors depends on whether the other side to your deal has engaged them. So if you're having face-to-face discussions with a buyer, it probably doesn't help to start introducing your lawyers before they have. So we're very happy to be in the background and kind of looking at your documentation, but until there's 2 sets of lawyers, whether you appoint professional advisors, whether those accountants or lawyers, may depend on whether you need a bad cop. So that's our key role in all of this, is to be blamed. So we're happy to do that. Then in terms of when you've got the offers on the table, it's thinking through which one is a better offer. And obviously, as with buying a house, the higher the number of people interested, the better your price. But it may be that a bottom line price is not as good when you look into the detail. So there are things that I know that the deferred consideration may not be very prominent in publishing deals, but in the deals that we see around services industries and in particular, there's often quite a large percentage of deferred consideration. I would say up to 40% of the purchase price can be seen in deferred consideration to be paid out over up to 3 years. So that may mean that you're looking at one deal which has a shorter period, and that's more attractive. In terms of the purchase price, some buyers will also be offering equity in the buyer as part of their purchase price. So here, tax structuring may become a part of your thinking, because what's very important is that you don't end up usually that you don't end up in the income tax regime rather than the capital gains tax regime. And so you need to sort of be careful how that is structured. There may be different requirements as to how long you're required to stay on as an employee. which again, you have to be careful with the tax structuring, but also you may want to stay on as an employee to make sure that you're protecting your deferred consideration. There may be discussions about liability caps at an early stage, although often those don't arise until you've reached a final documentation. But if that's something that is very important to you, you could discuss that early on. The restrictive covenants, obviously, whether you want to set up again in the same industry, that might be something that you're thinking about when choosing between the offers. So you have the discussion around the offers, and the next stage in the process is heads of terms, and that will set out your key terms. And here is where it's important to understand the difference between the enterprise value and the equity value and how that's set out. And hopefully the equity value will be higher, but the equity value is what you're actually going to get in your pocket. So that's the one that really matters, whereas most heads of terms will talk about the enterprise value, which is really what the buyer sees as the value in the business. So that will be based on the various valuation methodologies that we've talked about. So equity value then takes into account what's in the business, and this is it's quite common to talk about cash-free, debt-free deals, but then with an element of working capital. So that goes back to how do you work out at completion exactly what's in the business and what you can actually walk away with. So that's bear that in mind in when the headline figure may look a lot better than what you actually walk away with if there's a lot of debt in the business. Heads of terms are, well, we've got asterisk, not legally binding. The reason being that certain provisions are the confidentiality and exclusivity. Usually the payment for advisors, that's covered in the heads of terms. But they are morally binding in that it's very hard to move away from something you've agreed in the heads of terms unless there's something being discovered in due diligence or otherwise that makes the heads of terms no longer fit the situation. So we would say beware agreeing any points that you do anticipate negotiating later, because it's going to be very hard to do that. So once you've actually there is a slide not maybe missing here. So between the heads of terms and the share purchase agreement is the due diligence process. And this is where if you have someone in your business who's organised and loves a filing system, it's good to get them involved. Obviously, it's sometimes harder if you're trying to keep a transaction under the radar from employees. But if you do have somebody who can set up a virtual data room and index those documents to within an inch of their life, you'll be well served. The reason being that these documents that you disclose in the due diligence process at the beginning will then be relevant for the share purchase agreement itself, which talks about the warranties and then disclosing against those warranties. So when people first see a share purchase agreement, they're usually quite shocked. It's usually very, very long. It could be hundreds of pages, and it pays to take a step back at that point and think about what's the purpose of the share purchase agreement. And the principle in English law is buyer beware, caveat emptor, which is saying that you can only, once you've signed your purchase agreement, you're taking on all the risks of the company. And so the buyer then says, well, I want to be sure that I'm buying a completely clean company with no Easter eggs, no skeletons in the closet. And so they will include lots of warranties. And this is where it was talked about the putting these warranties into very much a sort of bespoke position. It's true that in most cases they are not very bespoke, particularly the ones we see, reason being that the buyer will say, okay, competition warranties that you've never breached any competition rules with the EU or otherwise, maybe that's not relevant to you, but then why can't you give the warranty, which is a slightly hard one to take, but to a certain extent that's true. If they're most of the warranties you're able to say not applicable to, then that means that you shouldn't have a problem giving them. But it's important and my suggestion is go through it with a ruler, with a very long ruler, and line by line read the warranties and make sure that there are no exceptions to those warranties. So if some of the warranties aren't correct, all is not lost. You can actually disclose against the warranties. So the means of disclosure, it's typically a disclosure letter which sets out the instances where a warranty is not correct. So as an example, if there's an employment warranty that says no employees have ever raised a claim against the company, you know that Joe Bloggs wrote a letter claiming claiming something 6 months ago. So you will then disclose that 6 months ago, Joe Bloggs sent this letter, and then if it turns, because the buyer will then know that that warranty there is an exception to that warranty, and they can't bring a warranty claim against you. Which then brings us to indemnities. So in this case, both sides think it's very unlikely that Joe Bloggs is going to be successful in bringing his claim against the company, but it may be that the buyer at that point says, actually, I think I want to give you a lower purchase price because there's this risk of Joe Bloggs out there. And so the sellers say, no, I'll keep my purchase price where it is. I'll give you an indemnity against it, meaning that if he does bring the claim, then I'm going to have to pay up against that. So that's sort of the key discussions in the share purchase agreement, which hopefully take less than a month. But that's the big document and takes a lot of time, and probably insufficient attention is usually given to the disclosure letter, which really should be the first thing that you start looking at to a certain extent, because you want to know that you've got protection against any warranties that aren't fully correct. It's important to look at the earnouts in the share purchase agreement. Most sellers are looking to crystallize their gain immediately at completion so that they can qualify for capital gains tax treatment, and going back to the BADR. So in terms of structuring those earnouts, it's thinking through how certain they are, how you can quantify what that earnout is worth. So then going on to the earnout section, because deferred consideration is such a big part of the discussions. Oh, sorry, I've got some questions. Sorry, I was just seeing here, earnout deal or similar, so not cash up front. Yes, I think, and that's Robert Murray Brown. I think that's right. So if you get an earnout deal, you're getting some of the cash up front, but not all of the cash. So it's essentially getting the earnout further down the line. So essentially then the question is, how are you defining that earnout? Now, obviously, if it's just that you get paid 60% up front, 20% after 1 year and 20% after year 2, then you're going to be, you know the number you're getting, and that's just deferred consideration. That's not an earnout. Whereas an earnout is saying you get 60% of what we think the company's worth on day one, but you're only going to get 20% after 1 year if the figures achieve X. Obviously, if that's based on profit, as every business owner knows, that's incredibly easy to manipulate. And so the vendor protections that Natalina talked about become very important. How do you make sure that a buyer is going to continue to run your company in the same way that you did, and maximize the earnout from your point of view? And that's where staying in the business becomes quite important, making sure that the employees who are involved in the business stay on board as well. And having, usually it's a schedule to the SPA which says, this is how I want you to behave during the earnout period. And if you don't behave like this, then if I don't achieve my targets, then that's a breach of contract by you. So I should still get my earnout payment. The usual means of looking at determining the earnout involve quite a lengthy process of somebody preparing a balance sheet after a year and then after 2 years, and then some room for negotiation, and then usually an independent expert, typically an accountant of high repute or otherwise, then can sit down and look at those numbers and try and get to the bottom of whether it's the buyer or seller who's correct. But it's important in your SPA to have sat down and thought, both sides really understand how this is going to be calculated, so that no one has any surprises when 2 years down the line, the person who's been going through the sale process with you, so the buyer who's super friendly and takes you out for a coffee, has moved on because they're the sales rep almost, and suddenly you're left with a person who is looking just at the contracts. They don't have any sort of prior history with you, and there's usually in share purchase agreements, well, actually always invariably in share purchase agreements, entire agreement clauses, which means that the that anything outside of the agreement can't be then brought into your future discussions. So saying, oh yes, but we exchanged some emails 3 weeks before completion where you said X, Y, Z, the buyer can then say, oh yes, but in the share purchase agreement, this is how we're going to decide the earnout. So the top reasons why deals go wrong, often it is discussions around the price and trying to get that chipped away by the buyer. And from a seller point of view, it becomes unacceptable. The surprises that Natalina mentioned, the due diligence, something crops up that really wasn't expected, which is why it's so important to get everything into good order. Delay, it may be that circumstances change. Obviously with COVID, quite a few deals that were steaming ahead fell by the wayside because it no longer fit within how people thought they were going to focus. And then loss of management focus. So if there are founder owners who also are the beating heart of the business, and they're spending a lot of time dealing with due diligence issues and so on, there can be a real sort of dip in how the company's going, which may make it less attractive to buyers, but also just cause everyone to decide not to go ahead. But actually, the good news is that most deals do go ahead. So once you've signed a heads of terms, apart from the couple of deals mentioned because of COVID, just about everything else has proceeded to completion. So deals we see, once people have sort of put some money on the table, engaged their advisors, started to look at a data room, then usually the deals do go ahead and complete. So I think that's it. Over to you, Modwena.
Oh, brilliant. Well, I thought that's a really useful summary. So while people are thinking about, I'm sure they'll have questions to ask you, I'm going to suggest you come off screen share, if that's all right. You just say,
yes.
Yeah. Okay, fantastic. So then we can just sort of chat, which would be nice. While people sort of think up their questions, tell us, there must have been some horror stories. It's always fun hearing the horror stories of buyers and sellers got into punch-ups in meeting rooms, or
well, it's quite interesting. It actually fits with William Russell's question about how important is the data room, and actually that's been one of the areas where I've had a 4 a.m. in a large law firm, kind of close to punch-up situation, which was where the buyers, because the sellers put so much effort into the data room, they've sort of put everything about the company into this data room, and then the buyers turn around and say, well, no, the data room isn't disclosed. What's disclosed is your disclosure letter and what your specific disclosures are to the warranties that you've talked about. So then there can be sort of this kind of tension of like, no, this is a beautiful data room. I want it all to be disclosed. If the information is in the data room, I know you've looked at it. You've had 40 lawyers looking through the data room. You know about what's in there. So yeah, that's usually a big area of contention.
And have there been any very exciting sales you've worked on where it was either very famous people, famous deals, or something where it was sort of, particularly curious? Or
I'm trying to think. I mean, there have been a few in the hospitality sector which have been quite exciting. Draft House, where sold the pub chain to Brewdog. That was quite an interesting one. It was watching, seeing different people in that sector. So there've been a few others who maybe I can't disclose, but it's always quite fun because it is you're sort of working quite intensely for a sort of period of time to try and get these transactions over the line, and you have to get to know their business very well in a short period of time. So they're definitely the more fun side of being a lawyer.
do you find there are you have to pull overnighters, or your clients do, or last minute calls?
Yes, not that often. I think if both sides are quite well organised, it doesn't necessarily need to be like that. But there is nothing like a deadline to get people to sort of agree on the final details. So the week before Christmas is always unbelievable in that everyone is trying to get their deal agreed so that they can enjoy Christmas. And the same actually for Easter is another very busy time. So trying to head towards a deadline is not necessarily a bad thing. I think it does mean that you as sellers have to be careful that you're not paying inadequate attention to some of the details. But yeah, that.
And because I know, because I've sold business, how many bits of paperwork are there when you sell a business? Because I think a lot of people think it might be a stock transfer form, but it isn't, is it?
It would be lovely if it was a stock transfer form. No, there's usually about 40 documents. The biggest is the share purchase agreement, but there will be a lot of other board minutes and corporate documents and pieces of paper, making sure that anything that was held by you in the business, so any personally held IP, for example, needs to be assigned over. So yeah, it's quite an administrative process at that point.
Yes, I know when we sold our family business, we had a long boardroom table in a lawyer's office, which was a big room with a big table, and there were just papers everywhere, and everyone solemnly went. I think having so much done digitally now, isn't it? But it is quite fun if you can have a sort of signing ceremony and actually meet and sign all these documents as you walk around the room. But it was so quite an eyeful, I suppose, to see it all and in action.
Yeah, well, when I started, there were actually physical data rooms. So you would actually go to I remember going to a power station in Grimsby and being shown a room that was full of documents that I had to then work through and summarize to prepare the due diligence report. So I think everyone's much happier now they're online, and they are, there are sort of various ways of providing them online. But the most important thing is to make sure that you're able to provide a copy at the end, because in sort of 3 years' time, when somebody's looking back at the data room, they want to be able to know what was in there.
Is there ever a time where the price actually goes up?
Yes, if the deal's taken a while and it's there's sort of a build-up of cash in the business, the buyer may not have been expecting the company to be as well run as it is, and have such sort of the inflows of cash to be quite so positive. So we definitely have had deals where that's the case.
Oh, that's really good. Excellent. Okay. So we've got some questions coming in. How does a share deal differ if the sale is an employee ownership trust?
There aren't many yet because they're relatively new, but it shouldn't differ. It would really be that where the cash goes after the sale is the difference. So it's going to go into the trust, and how the tax implications on the employees are different. It's more likely to be within the income tax rather than capital gains tax regime.
Okay, thank you. I've got on, what's the typical mix of earnouts versus deferred versus straight purchase in your current experience, and is it changing?
I see very few straight purchase, to be honest. I think that maybe it's the size of deals that we do, which is sort of up to, I mean, we've done a couple of deals that are sort of 50 million, but in general, they're usually around the 10, 15 million and below. So the buyers tend to want at least a couple of years to find the rest of the purchase price. I would say there's a slight move towards more earnouts, which probably sellers should resist, because there can be these elements of are you actually going to get your earnout? So that's a big, a slight change in the marketplace.
I think that's quite interesting, because you mainly are you mainly doing sort of more technology, or sort of very, because Natalina works in the sort of publishing industry, and I know there it's much more uncommon to have earnouts in sort of traditional publishing. So is there anything around, why do you think it is that some sectors have, do want earnouts and others don't? Is it just fashion, or is there something more fundamental?
I think it's like fashion. I think we work a lot with service industry, so it's wanting to know, for example, with IFAs, wanting to know that their book of business is as good as they claim it is. And I think it's knowing that the other buyers out there are offering the same terms.
Yeah, I think there's probably possibly another point, which is if you're doing businesses which are quite traditional and have stock, as we sort of alluded to earlier, quite often actually the way they're going to get payback is by reducing overheads, which is cutting staff. So versus something where you're buying effectively a service business, which is the majority, even software companies, they largely need people to sort of keep them going, and therefore you want to also tie the people all in together. So I think that might be it, but just interesting. It'll be interesting, some analysis of what terms go in what sectors.
I mean, I've heard it described as acqui-hires, which it shouldn't be, and I'm sure HMRC wouldn't like to hear it. But essentially, you're buying a business for the people. So then, in that case, that there will be very tough restrictive covenants, making sure that those people are incentivized to stay in that business for as long as possible, and earnouts sort of tied to. You can't. Usually you would resist tying the earnouts to actually having the individual stay in the business, but it's about because then it's a risk of it being classed as income tax, but you might well have sort of different rules around that, because you're really trying to keep those people on board.
Well, just explain that to me. So if they just buy the business to hire the staff, that's an acqui-hire. What does that? I've never heard of that. What's that?
No, it really is an acquisition, but it's really a hire of people. So yeah, acqui-hire. So
and that has different tax treatment then, does it?
If it is actually that HMRC would determine that really that's what you're doing, but then that's because you're tying it so much to the employees staying on, and the purchase price being tied to them staying on. So,
right. Yeah. So that what can affect the buyer's tax liability?
No, the sellers.
The sellers tax. Oh God. Okay. Oh, yeah. So in other words, so if they buy my company basically for my staff, and I sell it, I might have to pay income tax on rather than capital gains tax on the money.
No, it would be if all of your staff own the business. So it's if you've got an example where there's five people who are working in the business, they all sell their shares, and then they're required to continue working in the business for a number of years. Is that really a capital payment for the shares of the company, or are you actually just trying to get those individuals into your business?
Right, and effectively the payment becomes a sort of bonus and is taxable for income tax.
Exactly.
Oh gosh, right, that's one worth remembering. Always like it when I get a new fun fact. Thank you very much. Okay, I hope I've correct. Burkhard Sileshka is saying, is head of terms document the same as a term sheet?
Yes, it is. It can be a letter of intent, heads of terms, memorandum of understanding, term sheet. It's all the same. I mean, they may have slightly different slants, but they're all essentially, they will have the binding provisions, which are the confidentiality, exclusivity, and then the rest of it is just setting out the outline of the terms.
We've got one here. What are the 3 top devils in the detail for an entrepreneur to be aware of when selling their business? Or the top 3 devils in the detail to be aware of in an earnout? So there's 2 questions there.
Right. So in selling the business, I would say getting your accounts in the right sort of form and looking at the company probably ahead of time. So if you are going to want to spin out toxic assets, then you might want to think about restructuring a few years before the sale, because that may be the most tax efficient way of doing it, or otherwise. So if there are things in your business that are going to be problematic, it's looking at those quite early. I'd say the warranties, going back to the warranties with your ruler, and looking through what exceptions there are that are problems in your business, and then the data room, and keeping that in really good shape so that you can use that to say, look, I've told you X, Y, Z about my business, you know it. So that would be, I guess, my top three. And then in an earn-out agreement, I think it's the detail about how are you going to work this out in the future. And it's the making sure that in the interim period, so between your completion, when everyone's all smiles and drinking champagne, and the 1 year later, where you're sort of looking for your earn-out payment, the buyers can't say, oh, this was, we didn't actually mean it in this way, and you're not going to get your full earn-out payment. So I don't know if that was three, but yeah.
Good, thank you. Right, there's more. So, do you recommend meeting potential prospective buyers?
Yes, I think trust is a huge part of this, because you're disclosing all the details of your business, and you don't want to a prospective buyer to simply use it as a data gathering exercise, which they can then go on and use without actually acquiring your business. I mean, that could be protected to a certain extent by non-disclosure agreements and being careful what you disclose, but really that you want to be sure that you trust them. So that's meeting in person will always help that. I think in an era of Zoom calls and so on, you can get a good sense of people, but it's never really a bad thing to meet in person.
Good, thank you. Some more coming in now, Helen. Has anyone come up with a clever, a more stable measure for earn-outs than EBITDA, which is clearly up to manipulation, maybe a mix of gross profit margin and revenue?
Yes, some people will look at revenue, or they will, if it's a particular industry, you can look at the metrics within that industry. So the example of IFAs, because we're seeing a lot of sales of independent financial advisors at the moment, there you will look at their the number of clients and what their assets under management. So you can use that as a metric instead. So it's in different sectors, you can look at other metrics rather than the EBITDA, because, as you say, it's so open to manipulation, and yeah, it's not anyone's favorite. So any other means of saying, look, we're showing that the business was successful, we're showing that the number of sales has stayed constant, pay up.
Really interesting. Are you seeing mainly acquirers in the UK, or do you see many overseas coming in? What's the sort of mix of purchasers out there?
I'd say at the moment it's maybe not quite half, but there's a big number of US buyers at the moment. There's some European, but a lot of US investment into conglomerators. I think that's how you describe them. So there are people who are looking to acquire a lot of businesses in a particular sector and put them all together, and economies of scale, and think they can make it work. But there is that's where a lot of the money is coming in at the moment.
Okay, and are you seeing so something I was always taught was that most companies sell for 3 to 8 times EBITDA, and that because most companies, that means you have to probably get to 2 to 5 million EBITDA to be anywhere near 20 million, and therefore there's a sort of massive mismatch between what entrepreneurs sort of think they're going to get for their hard work and what they do get. Am I right or am I wrong?
Yeah, I mean, especially when your EBITDA is on the lower end, the problem is that buyers then start looking at it and saying, well, also there's 3 founders here who are being paid 10 grand a year. If they were actually paid a real salary, the EBITDA would be even lower. And so it's factors like that can push the number down even further. But obviously, sellers don't have to sell. So if you've got a good business and you can hold your nerve, then you can get the price that you think the company deserves, because you've got something that somebody else wants, and that ultimately is like any other asset, how that works.
Okay, but do you think the 3 to 8 times EBITDA is a good sort of multiple to I mean, I think what it does sends a message to entrepreneurs, which is drive profits. And I think it's not just for the vast majority of businesses, the unusual ones, which suddenly, I know there's the one in Bristol, which was a sort of insulin business and it had a patent and sold for 480 million, but they're very abnormal, aren't they? They're, if you're on a sort of sensible journey to grow a business and sell it, you want to grow that EBITDA as high as you can and get the margins as high as you can, don't you? That's the core message. If you want to sell at a good price, it's not just, I know, haven't I done well after X many years?
Yeah. Well, BDO produce a quarterly multiple number, which is for private company sales, and that usually hovers around the 10 number, and that sort of looks at every deal that's taken place in the last quarter and gets the numbers for it. So it's a really helpful metric of where the numbers are going up or down.
Oh, so you're saying 10 times EBITDA, not 3 to 8.
That's for more for less risky businesses, and probably with greater asset base. Obviously, the lower your asset base and the length of time it's been established and everything else, I think 2 is probably a good starting point to think about, so that you're not getting your expectations too high. But then, you can think it may be up to 10.
Okay, thank you.
Really depends.
Brilliant, thank you very much. With some more, there's a couple. Yes. It's from William. Should you have a dispute resolution outlined in the SPA?
Yes, I would say yes. So you usually have different dispute resolution procedures for different elements. So there may be a dispute resolution procedure for determination of the completion accounts, for example, which means that you want to avoid going to court. I know I shouldn't say that as a lawyer, because obviously we should want people to go to court, but we really don't. So if you have a procedure whereby you've got a number of days between sort of when somebody reviews and somebody else reviews, and you look after it and you do some internal discussion, and then you've got an external, either accountant or barrister or somebody, to look at those numbers and make that determination to save you having to go to court, that's very sensible. And the same actually applies with that earn-out schedule that you see to the SPA, where you're wanting to say, how much am I going to get in 2 years' time? And if you can decide it without just by having a single expert rather than going through the court procedure, you're probably going to actually get people following the procedure that's set down, rather than if they're thinking they have to go to court, and that may put both sides off. There's also obviously deciding how the costs are decided for that dispute resolution. So there's an argument for saying, if one side says price 10 and the other side says price 20, and the expert comes back and says it's price 10, then the person who said price 20 should have to pay the costs. So it's thinking around that.
Oh, I see. That's rather interesting. Good. Just to give, could you give us an idea approximately? I know you probably never want to be a generalist about the costs of doing the transaction, but typically, what do the accountants, corporate finances, as lawyers charge? Because I think if most people are, and particularly as you say, where if you've got a company with sort of angel backers and entrepreneurs in it, and the pot may be 10 million, and they're sharing it out between, let's just say, 10 people. This probably isn't the gangbuster that made you 100 million. How should people think about what they pay for the service they're being given by the different professional advisors, and how should they ensure that they get sort of good quality service?
I think it's sort of discussing with those advisors what they're actually going to provide. I would say, how long is a piece of string to a certain extent? I think most deals, the corporate finance fee it can be by some degree the largest single element. I'd say they're often around 6 to 7 times the accountant fees and lawyer fees combined. But on the other hand, they can also push your price up. So if you're getting that much more for your business, then they're well worth it. So accountants and lawyers, the fees could be anywhere from 10,000 to 100,000 for the accountants and the lawyers. I would say it really depends on every detail of the business, but because they are so document heavy and there's so much work involved, it's hard for the fees to be any lower than the 10,000. I would say whoever you get looking at it. And if they're higher than 100,000, then I think maybe you need to think again about who you're working with and whether it's really proportionate.
Okay, thank you very much. We've got a sort of a Q&A from Chris, which is, what about doing due diligence on buyers, and how does that actually work? Because, you know, presumably you're relatively like, please buy me, you know, how do you approach the issue, and what due diligence do you have to do?
I think you do have to do it. I mean, we often, especially if they're setting up an SPV to buy you or something like that, you want to know that the parent is standing behind that. So it's really, I mean, Companies House is a good place to start if they're a UK buyer or the equivalent in whichever jurisdiction. Look at the accounts, how long have they been going, and just really be sure that they've got the financial wherewithal. And if they haven't, then you can think about putting the earnout into escrow or sort of being held by a third party. That's much more common in US deals, to be honest, but it does happen.
Okay. Good. Are you seeing much in the way of sort of management buyouts and other, or maybe angel buyouts or other things, sort of alternative things happening that are rather than sort of vanilla trade sale? And anything curious you're seeing happening in the market at the moment?
Yeah, I'd say there's more MBOs going on. There are people sort of, I think probably what's been going on in the world in the last couple of years has made people think about whether they want to continue, which is why there's huge amounts of activity in the M&A market at the moment. And part of that maybe is that the best buyers out there are the employee team. So they're thinking about it, and there are also funders who've moved into that sector. So there are people who are willing to lend to the employees who can then sort of buy the business from the current owner.
Okay, what do you have a view on if you want to sell and management want to buy and trade buy, you're going for a trade sale? How do you manage that intrinsic conflict of interest?
Ooh, that's an interesting one. I think it's about sort of discussion in the end. I think it's working out I mean, as owner, you obviously have to think of yourself first, and it's what's going to end up in the best position for you, and whether that's, I think the one key advantage of the MBO is not going through that due diligence process, not going through the stress of somebody chipping away at the price, criticising your terms and conditions and everything else. So if there's not that much difference in the price, you might think that the MBO will give you a more satisfactory experience than a trade sale, where there's going to be a lot of digging into everything that's going on, and potentially if the trade sale fails, you've given away a lot of confidential information. So
yeah, when we sold, we had the management wanted to buy, and what we did, we gave them an exclusive period really before we started the trade sale and said, this is your chance. And then we also we ended up, I think we gave them a bit of an incentive to sort of get the trade sale over the line. Yes. It was more complicated than that really, but I don't want to go into the detail, but you can you might well have to incentivize your team to help you get the business over the line. I think that's something people sometimes forget, that as a rule, so I'm interested to know what you think about this. Do you how many people should you tell in your company that you're selling your business?
I think in most companies you will know there are some people who you can't possibly pull the information together without getting them on side. So those kind of key people, you have to accept that they will need to know if you want to get this done. But in general, probably trying to keep it to a minimum, because they're sort of reach the tipping point where then everyone's going to know about it. And maybe then in that case, it's the case of gathering everyone together and just being open about it. I mean, the great thing in your instance with having a trade sale as well as MBO talking about it is so then you've got a genuine marker of what a company's worth. So that's, I think, always the problem with MBOs is how much is the business worth. And so if you've got an external interest, it gives you a clear marker there.
Yeah, I think, I mean, my view is you tell nobody. If you could get away with it, you'd tell nobody, if you see what I mean.
Yeah.
And it starts there. And then when we sold our business, we didn't tell the accountant. We just
Wow.
asked for lots of schedules.
Yeah.
Now he may have guessed, but he wasn't put in a position where he'd ask. So
Yeah.
so that, I think that's something a lot of people, like often entrepreneurs go, I'm just about to tell the team I'm planning to sell. You go, no, you don't understand. An employee doesn't see a sale as, well done, you're making out like a bandit. They see it as, damn, I'm going to lose my job, and they go.
Yeah.
So it is really important to keep it really, really tight, isn't it?
I agree. Yeah.
So
there's another question.
Yeah.
Increase of company sales out of administration, and should the law be changed to protect shareholders? Yes, I guess on the basis that there are an increased number of companies going under at the moment, then yeah, we are seeing Phoenix deals. I mean, they shouldn't, in theory, the founders who are buying the assets of Phoenix should be matching the price that any other third party would pay. It's an interesting, I don't know how you would protect the shareholders apart from maybe if the company had gone insolvent, requiring a sort of a period of time after within which the success of the Phoenix business should be paid back. And I don't know if you could put that in a shareholders agreement at the beginning in those companies to say, if this fails and the founders buy this out of the ashes and it's successful and sold again, sort of put in an anti-embarrassment clause.
Okay.
Take them into the creditors. I don't know if it's sort of a second ranking creditors. Yeah, I can see that as maybe that would be a change.
Okay. So John is saying, are you seeing extra value being attributed to B Corps or the reverse? That's interesting.
Definitely not the reverse. I don't know how much extra value is genuinely being attributed. It should be. And I think in to a certain extent, it's quite hard to get the B Corp status. So it should be a badge of this is a really well-run company that is able to fulfill all the requirements of a B Corp, therefore buy it. So that there may be an element of that. I'm sure it's going to grow, and there will be presumably buyers who will only buy B Corps, I would think, longer term.
Okay. Thank you. Brilliant. Well, we've got a few more minutes if anyone's got any last minute questions. I think we've had a pretty thorough going over the whole idea of selling businesses. People write books on it. There are various things. Are there any tips you've got for sort of angel investors in getting their exit in selling a business? Anything you?
I guess in the investment agreement, it's looking at some investors will say, okay, well, when it comes time to the warranties, how much involvement do I want to have? So the fundamental principle or the starting point for a lot of agreements is that there's joint and several liability for all sellers. So theoretically, unless you claw it back, that could mean that you, Mr. Investor, with your 10% of the company, could end up with liability for 100% of the purchase price, because that's the terms in the contract. So it may be worth thinking in the investment agreement, very early stages, I'll give warranties as to ownership. Fine, I'll say I own the shares, but I'm not going to give any other warranties. And if you can't find a buyer on those terms, then they're not the buyer for you. So that's something to think about.
Okay, that is worth thinking about. Thank you. Good. And is there anything particular, any highlights you have to think about tax? So we've got entrepreneurs relief, haven't we? And is there still investors relief where we pay 10%?
Still there. That's right.
Are there any you're not seeing anything come up whereby these tax reliefs are being reduced or taken away, or is there's nothing in the way the sale works which affects you getting your tax relief on those?
No, I mean, we're always waiting for the next budget to see, but I think there has been some incentive for entrepreneurs in some form or other for a good couple of decades, and we do expect that to remain, because you are trying to incentivize people to take the risky step of setting up businesses. So there's sort of there should be an upside for them from doing that. But it's really, I think there may be greater attention paid to, say, how much of a company's cash is involved in the purchase price. That may be sort of something that could come under the spotlight.
Okay, that's really good. Well, I think we might have sort of made everyone, told them everything. I thought it might take the whole 90 minutes, but we've got 8 minutes to spare to go and have a cup of coffee, I think. So, I really appreciate that, Helen. I think it was, yeah, really helpful. And thank you. Well, thank you very much, William, for saying thank you. We really enjoyed it, and I hope you found it valuable. Helen, would you like to read out your email address to everybody? Because I'm sure.
Yeah, so it's helen.curtis, so my name, @gannons.co.uk.
Good. So I'm sure you can find her on the interweb, as my family always say. And if anyone wants to reach out to me, you know where I am. We hope to see you again. So I think we're going to do another webinar, aren't we? Sometime we're going to try and squeeze it in sometime soon. So so watch out for another exciting episode with Gannons and Angel News and Funding Index. Have a good one, everyone. Thank you very much, and see you soon. Bye.
Thanks, everyone. Thanks. Bye.